so by the end of this video, you're going to better understand how cryptocurrency transactions are taxed, which types of crypto actions you're required to pay taxes on, and then what forms you'll need to file your tax filing. Before I go any further, I gotta say this. I have to note that everyone's tax situation is different, and I'm not providing tax advice, okay? So it's really important to consult a tax professional depending on your specific circumstance. Okay, so let's start with the obvious. How cryptocurrency transactions are taxed. The first question we should answer is this. Do you really need to pay taxes on your crypto activity? Yes, the IRS knows that only a fraction of people buying, selling, and trading cryptocurrencies were actually properly reporting those transactions on their tax returns in the past few years. In October 2019, the IRS provided further guidance on how cryptocurrency should actually be reported and taxed, which was the first update of its kind since 2014. And then, beginning in the tax year 2020, the IRS also made a change to the Form 1040 and began including the question, at any time during the year, this time 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? Even if you check the box for no, but you actually did, they'll get you somehow. Here are the common ways taxable events are incurred through cryptocurrency. First one is the most common. If you sold crypto. So while people refer to cryptocurrency as a virtual currency, it's not necessarily virtual in the eyes of the IRS. According to the IRS Notice 2014-21, the IRS considers cryptocurrency to be property, and capital gains and losses need to be reported on Schedule D and Form 8949 if necessary. Basically, they view cryptocurrency the same way as they do stocks or ETFs, mutual funds, and all those other standard investments. And like other capital gains and losses, your gain may be short-term or long-term depending on how long you held the cryptocurrency before selling or exchanging it. And if you own the cryptocurrency for 1 year or less, any profits are typically short-term capital gains, which are taxed at your ordinary income tax rate. On the other hand, if you held the cryptocurrency for more than 1 year, any profits are typically long-term capital gains, subject to long-term capital gains tax rates. These are typically lower. For example, if you bought one Bitcoin at 40K, let's say, and then you sold it at 60K later in the year, you owe taxes on the $20,000 in capital gains that you made. If you held Bitcoin for longer than 1 year, let's say, you would pay long-term capital gains tax rate, which is 15 or 20% for most taxpayers. If you held that Bitcoin for less than 1 year and then sold it, you would get taxed on those capital gains just like your ordinary income, which is typically higher for most taxpayers. Now, this can be seen as one advantage to holding onto your crypto for a longer time period. I'm not giving any advice there, I'm just saying that that's the difference. All right, if you sold crypto at a loss, we're not all gonna admit this, but if you sold crypto for less of a value than what you paid for it, this is considered a capital loss. Now, these losses can work to your advantage, just like automated tax loss harvesting losses can do, which lets you use losses to offset gains and income. You can use losses to offset those other capital gains, including from non-crypto assets, like stocks, that you incurred during the year. So a dollar for dollar basis, potentially reducing your overall tax bill. If you have more losses than gains or have no gains at all, let's say, you can offset up to $3,000 in other income with these losses for each year. Any remainder amount of losses carries over to subsequent years until the full amount of the loss is applied. You should keep track of this. So cryptocurrency trades are taxed the same way as your other more traditional investments, right? The issue here is that keeping track of your crypto transactions can get seriously complicated. When talking about how you report crypto on your tax return, this depends on how you got it and how you used it. First off, hit subscribe. You're gonna like more of our content that we have to share. First situation, if you mine cryptocurrency. Cryptocurrency mining refers to solving cartographic equations to validate and add cryptocurrency transactions to a blockchain in exchange for the work, then miners then receive cryptocurrency. If you earn cryptocurrency by mining it, it is considered taxable income and might be reported on Form 1099 NEC at the fair market value of the cryptocurrency on the day that you received it, just as if it were self-employment income, for example. You need to report this taxable income even if you do not receive the 1099 form. Another example, if you receive cryptocurrency as payment for goods or services. So if someone pays you crypto in exchange for goods or services, the payment counts as taxable income, just as if they'd pay you via cash or credit. For tax reporting, this dollar value that you receive for goods or services is equal to the fair market value of the cryptocurrency on the day that you received it. Next example, if you spend cryptocurrency. If you own cryptocurrency and then spend it, you may incur taxes resulting in a gain or loss just as you would if you sold that stock. This is where cryptocurrency taxes can get really complicated. So let's go through an example. Let's say that you received $5,000 worth of cryptocurrency Bitcoin in exchange for services done on January 15th. 6 months later, on July 15th, the fair market value of your Bitcoin has increased to $9,000, and you use it to buy, let's say, a used car. On your tax return for that year, you should report $5,000 of ordinary income for receiving the Bitcoin in January and a short-term capital gain of $4,000. That's the $9,000 value of your Bitcoin when you purchase the car minus your $5,000 basis when you actually receive that Bitcoin. Now, these two cryptocurrency transactions are kind of easy to track, but imagine you purchase $1,000 worth of Bitcoin, load it onto a cryptocurrency debit card, and then spend it over several months on coffee and groceries and lunches and everything else. Most people view cryptocurrency as a cash alternative and aren't actually keeping track of capital gains and losses for each of these transactions. So it can be super complicated to go back and try to calculate the tax implications for each one of these. How about if you exchange one type of cryptocurrency for another? Well, many people also often exchange or trade one type of crypto for another, right? For example, let's say you have $1,000 worth of Bitcoin and exchange it for $1,000 worth of Ethereum. If you originally paid $300 for that Bitcoin, you have to recognize a $700 capital gain when you make the exchange. Whether you owe short-term or long-term capital gains on that $700 depends on how long you held the Bitcoin before exchanging it for the Ethereum. The same goes for when you, let's say, buy an NFT. You are technically exchanging one crypto for another type of crypto, and then you're taxed on any gain associated with the original crypto used to buy that NFT. If you then sell that NFT at a later date, you'll also be taxed on that as well. There's a lot going on when you exchange or use crypto for daily transactions. All right, so we talked about the taxable events with crypto. Now let's talk about the non-taxable crypto events. It's also important to understand all the scenarios in which a crypto event is not considered a taxable event. All right, first example, buying crypto with cash and then holding it. Just buying and owning crypto is not a taxable event on its own. The tax is incurred later if you were to sell and then its gains are actually realized then. How about donating crypto to a qualified tax-exempt charity or nonprofit? In this example, if you give crypto directly to a 501c3 charitable organization, you may be able to claim a charitable deduction. So it's not a taxable event necessarily. Receiving a gift. If you were lucky enough to get crypto as a gift, you're not likely to incur any taxes until you actually sell or participate in another taxable activity like staking, for example. Giving crypto as a gift. You can gift up to $15,000 per recipient per year without paying taxes. If your gift exceeds $15,000 per recipient, you'll need to file a gift tax return, which generally does not result in any current tax liability. If you transfer crypto to someone else outside of purchase or for goods or services, it may count as a gift as well, even if you didn't mean it that way. Another one, transferring crypto to yourself. Transferring crypto between wallets or accounts you own is not taxable. You can transfer over your original cost basis and date acquired to continue tracking your potential tax impact for when you eventually sell. All right, so finally, let's talk about the tax forms that you'll need to use for filing your taxes when it comes to crypto. The 1099 MISC, miscellaneous income. If you staked or earned any type of crypto during the year, totaling more than $600, your crypto broker is required to report your transaction to the IRS as miscellaneous income using the form 1099 MISC. And so are you. This also includes any interest you made from any stablecoins. So even if you earn crypto income below the $600 threshold, you'll still have to report the amount on your tax return. Most crypto brokerages only report this form 1099 MISC to the IRS. But since crypto tax rules are still kind of messy, your responsibilities, unfortunately, they don't end there. Another form, 1099B. If you sold crypto during the year, this one gets messy. You'll also need to report all of your capital gains and losses when you file your taxes. Even though most brokerages are not going to report this directly to the IRS on your behalf or send you any type of Form 1099-B, you are technically responsible for this in your tax return. And on top of that, not only do most crypto brokerages not report it to the IRS on your behalf, they also don't calculate your gains and losses for you. You're likely going to have to download all transactions and then calculate this yourself, which, like I've said before, gets messy. There are a few different ways to calculate your total gains or losses here. To find your cost basis, some crypto firms use an accounting method called highest in, first out. HIFO, meaning your highest cost assets are sold first, which may result in a lower tax bill. HIFO is just one way to calculate cost basis, but it's likely going to be the most common method considering that the volatility we saw with crypto in the past year. All right, thanks so much for watching. If you might find this helpful for someone else or like your friend, send it to them as well. This is Tony from Wealthfront. Thanks so much for watching.